Welcome back to the deep dive. Today we're opening up the books on Tamilnad Mercantile Bank TMB, let's call them. Got the Q2 FY FY26 results right here. And yeah, our goal today is pretty straightforward. Cut through the dense regulatory filings, the long analyst calls, and really just give you the critical insights, what's actually happening with TMB's operations, their strategy, and maybe uncover the story behind those big headline numbers.
Yeah, and we've got some solid material to work with. The official press release, the outcome from their board meeting on October 27th, 2025, and crucially, the transcript from the analyst conference call. That management commentary is key to understanding their thinking.
Right. And the immediate hook, the thing that jumps out, is this news about their highest ever quarterly net profit in Q2 FY26.
It sounds like a massive win, doesn't it?
It really does. But before we get too carried away, we need to ask, is this sustainable profit? Is it coming from their core business, or is it flattered by something else, maybe some historical stuff?
That's exactly the question. Let's dig in.
Okay, let's kick off with the top line stuff. Year-on-year growth. Seems like they're building some real momentum. Total business grew by 11.40%. And they actually mentioned this is the highest YoY growth they've seen since TMB listed.
That is a noticeable step up. And it's broad-based, too. Deposits look strong, up 12.32%. That's 55,421 crores now. And lending is keeping pace. Advances grew 10.34%, hitting 46,930 crores.
Which leads to that net profit number up 4.95%, reaching or even 318 crores compared to 303 crores last year.
Yep, 318 crores.
Okay, but here's where it gets a bit confusing when you look closer at the filings. If net profit is up, business is growing. Why did the reported operating profit show a decline? It was down almost 3% year over year.
Right.
That seems like a contradiction, sort of a red flag, wouldn't you say?
It definitely makes you pause, and this is really the critical piece you need to grasp to understand TMB's Q2 performance properly. The issue isn't this quarter, it's the comparison quarter. Q2 of FY25. Last year.
Okay. What happened then?
That quarter's profit was, well, artificially boosted. They had a very large one-time recovery from accounts that had previously been written off. A windfall, basically.
Ah, okay. So it wasn't core operational profit last year. It was this extra recovery boosting the numbers.
Precisely. A big one, too. We're talking 98.55 crores recovered. That's nearly 100 crore rupees that wasn't generated from day-to-day banking.
Wow.
Yeah. It was split. About 61.65 crores came through other income, and another 36.90 crores actually boosted interest income.
Okay, so that really muddies the waters for a year-on-year comparison.
Yeah.
If we sort of mentally adjust for that, take out that big non-core recovery from last year's number, what does this year's performance look like then? Much
healthier. If you make that adjustment, normalize the base from last year, the Q2 FY26 operating profit was actually up strongly. 19.83% year on year.
19.83%. Okay, that paints a completely different picture.
It really does. And net interest income, the NII, that was up 6.32% YoY on that adjusted basis too. So the key takeaway here, TMB's underlying core business is accelerating. They're moving away from relying on these historical, lumpy recoveries.
Right, so this idea of shifting from a, let's say, recovery bank towards being a growth engine, that seems to be supported by their absolute bedrock asset quality. I mean, these numbers are quite something. They stand out compared to a lot of other banks.
Oh, definitely.
Just look at the improvement year on year. Gross NPA, that's non-performing assets, dropped significantly. It's down to 1.01%. They highlighted that's the lowest it's been in a decade.
Lowest in 10 years, yeah. And the net NPA after provisions is even lower, just 0.26%, down from 0.46% last year.
0.26%. That's almost negligible. It suggests a very, very clean loan book.
It reflects disciplined lending, for sure.
Yeah.
And they're not just cleaning up, they're also building buffers. Look at the provision coverage ratio, the PCR. Even without counting technical write-offs, it's jumped significantly. From 66.48% last year up to 74.36% now. They're putting more aside.
Okay, 1.01% GNPA is fantastic, no doubt. But let me play devil's advocate for a second. Is there any chance they're being too cautious, sacrificing potentially higher yield growth by being so focused on low risk?
That's a valid question,
Yeah.
Their conservatism is definitely their defining feature. But it acts like an insurance policy. And here's maybe the most telling stat in the entire report. The average collateral backing all their NPAs, the bad loans they do have, stands at an incredible 111.09%.
Wait, say that again? Over 100%.
111.09%. yes.
So even for the loans that have gone bad, the collateral they hold is worth more than the loan amount, on average.
Exactly. Mathematically, they're over-collateralized even on their problem assets. The expected loss when they eventually resolve these NPAs is likely very, very low. It's like a fortress balance sheet.
Wow. Okay, that explains a lot about their stability.
It does. And that stability lets them face future regulatory changes with confidence, like the upcoming expected credit loss norms, the ECL rules.
Right. ECL. For listeners maybe not deep in bank regulation, can you quickly explain what ECL is and why it's causing headaches elsewhere?
Sure. Basically, ECL flips provisioning on its head. Instead of waiting for a loan to show signs of stress before you provision, banks have to estimate the expected loss over the entire life of the loan, right from day one. For many banks, this means finding huge amounts of extra provisions up front. TMB ran the numbers and figured they'd need about an extra euro 210 crores under ECL.
Okay, so a significant hit potentially, but TMB had a plan, it seems.
They did, yeah. Clever bit of prior planning. Management confirmed on the call that they already have a 250 crore provision buffer sitting on their books. It was created originally for COVID-19 risks and other general contingencies, and that existing buffer is actually more than enough to cover the new ECL requirement.
So they essentially pre-provisioned for future regulatory changes without even knowing the exact rules. That's smart.
Very smart. It means, as they stated, no impact on P&L or capital adequacy anticipated. It gives them a huge advantage over banks scrambling to find those provisions now.
That foresight is impressive. And it probably helps that their unsecured exposure is tiny too, right? Just 0.30% of all loans.
Extremely low, yeah. Very little risk there. Just quickly, before we move to strategy, there was a small governance update. Two non-executive directors, Theru S.R. Ashok and Theru D.N. Naranjan finished their terms on October 27th, 2025.
Oh, okay. Anything significant there?
Not really. It seems standard. They completed their maximum 8-year tenure allowed under the Banking Regulation Act. Just a routine departure.
Okay, so moving from risk and governance towards the future. Strategy. Management talked a lot about their phygital approach, that blend of physical branches and digital push.
That was a key theme.
And they hit a physical milestone this quarter, didn't they? Opened 9 new branches, which brought their total network up to 600.
That's right. The 600th branch was opened in Vizinjam, Kerala, which is interesting in itself, opening outside their home state of Tamil Nadu. Signals that expansion intent.
And that network seems focused on safer lending areas. You mentioned the loan book composition earlier.
Yeah, the shift is clear. The retail, agri, and MSME segment, what they call RAM, now makes up 94.59% of their total gross loans. That's up from 92.34% year ago. And within that, retail loans specifically saw huge growth, up 40.12% year on year. That's where the expansion focus is.
40% growth in retail, wow. Now, to support all this, the physical expansion, the digital side, they're putting serious money into technology. I saw the IT budget figure. It's quite a jump, isn't it?
It really is. Planned IT spend for this fiscal year, FY26, is 250 crores.
250. And last year it was, what, about 150 crores?
151.66 crores last year, yeah. So it's a massive increase, around 65%. They're essentially buying a whole new tech stack.
And how are they splitting that? Is it all hardware or?
No, they mentioned it's split evenly. 125 crores for CapEx new systems, hardware, and 125 crores for OpEx running costs, software licenses, personnel. That balance tells you it's a long-term investment, not just a one-off purchase.
Makes sense. Were there any specific tech initiatives launched this quarter that really caught your eye, things that signal the direction?
A few, yeah. The launch of the Oracle Fusion CX platform stands out. That's their new CRM, Customer Relationship Management System. Implementing a modern CRM like Oracle Fusion's is a big deal. It suggests a shift towards, more sophisticated, data-driven customer acquisition and service. That's crucial if they want to grow effectively outside their home market.
Right, moving beyond just relationship banking in their core region.
Exactly. They also rolled out UPI payments on their RuPay credit cards, which is becoming table stakes now, and they partnered with a company called WeGoFin Digital Solutions under the bank as payment aggregator, or BAP model, that lets them embed their payment services in other platforms, expanding their reach.
Interesting.
Oh, and they launched a new call center, state-of-the-art apparently, with AI calling features integrated. Needed, probably, if they're serious about scaling up.
All this points towards expansion, but geographically, they're still very concentrated in Tamilnad, right? About 3/4 of the business still comes from there.
That's correct. Roughly 75% of both loans and deposits. Management was quite clear about needing to change that.
What's the target then?
They stated the goal is to increase the share of branches outside Tamil Nadu to over 35% of the total network within the next 3 years.
3 years. That's quite ambitious.
It is. And it's not just about opening physical branches. They specifically mentioned using partnerships and targeted recruitment to ensure they get local talent and expertise in these new non-TN areas. That's probably the key execution challenge, managing that geographical diversification effectively.
Okay, so Q2 showed good adjusted momentum, asset quality is stellar, and there's this big strategic push with digital expansion and tech investment. What does management expect looking ahead? What are the targets for the rest of this year, FY26 and beyond?
Well, their guidance for the full year reflects growing confidence. They expect to finish FY26 with credit growth between 14% and 15%.
14 to 15%. That's faster than the H1 growth rate.
It is. Suggests they expect these investments, the new branches, the tech upgrades, to start paying off pretty quickly in the second half of the year. And deposit growth guidance is also strong, 12% to 13% for the full year.
And what about margins? Net interest margin, NIM, often under pressure for banks.
They address that directly. They actually expect NIM pressure to ease off and for the NIM to stabilize and potentially rise to 3.85% or even slightly higher.
Rise. How are they forecasting that when funding costs have been going up generally?
It comes down to their deposit structure. Turns out, about two-thirds, 66% of their term deposits are in the 1 to 2 year maturity bucket. A lot of those were booked when rates were higher. As they mature over the next, say, 2 quarters, they'll reprice at current, likely lower rates. That naturally brings down their average cost of funds.
Oh, okay. So they have this built-in tailwind for margins coming up.
Exactly. That deposit repricing gives them a bit of an advantage over the next 6 months or so.
Now, looking further out, profitability. Management seemed quite bullish about FY27. They called it a potential breakout year, aiming for profit growth around 20%.
Yeah, 20% plus or minus 3%. That definitely caught my attention. It feels ambitious for a bank historically known for its steady conservatism.
It really does. What gives them the confidence to target that kind of growth next year, especially with the ongoing costs of that big IT overhaul and branch expansion still flowing through?
Their bet seems to be on operating leverage. The idea is that once the new IT systems are fully bedded in and the expanded RAM portfolio starts generating income efficiently, the cost base won't rise as fast as revenue. They believe the heavy lifting on modernization and expansion costs will be largely done, allowing the benefits to flow directly to the bottom line by FY27. And they weren't just talking about 1 year, they committed to sustaining that kind of growth, 20% plus minus 3% for at least the following 2 to 3 years.
Sustain 20% growth. Okay, that's a bold vision.
It is. It signals a fundamental shift in their ambition.
Right. Before we wrap up, we should probably quickly cover those 2 minor risks that came up in the source materials, just to be thorough.
Good point. First, there was that old shareholder case related to a bonus share issue. The key takeaway is the maximum potential financial hit to the bank is tiny, just 2 lakhs, the maximum penalty under FEMA rules.
And they've already provisioned for it.
Yes, already provisioned. So
Yeah.
effectively a non-issue from a financial perspective. Second, there were some questions about exposure to potential U.S. tariffs, maybe impacting exporters. Again, the exposure seems minimal. Their total export credit book is only about 1.05% of their entire loan book. And within that small slice, only about 17.5% is actually linked to the U.S. So the potential impact on the overall portfolio looks negligible. Hashtag outro.
Okay, so let's try and synthesize all this. If you pull together all the pieces, the adjusted profit, the amazing asset quality, the strategic shifts, the picture seems pretty clear. TMB looks like it's successfully making a transition, moving from being, a steady, conservative, regionally focused bank.
Maintaining
things, towards aiming to be a genuine growth engine. And that growth ambition seems grounded in really solid fundamentals, especially that 1.01% gross NPA. That's best-in-class stuff. Plus, the aggressive digital investment plan provides the tools.
I think that's right. And the final key takeaway for you listening is probably this. The growth we're seeing now and the growth they're forecasting seems much more organic. It's driven by core banking activity. They've managed to de-risk the story, moving away from that reliance on those lumpy non-core recoveries we talked about earlier. The focus now is clearly on using technology and expanding geographically, pushing beyond Tamil Nadu to build a proper pan-India presence.
It really is a fascinating setup for the next couple of years, which leads me to a final thought for you to mull over. Given TMB's incredibly high capital adequacy, their CRAR, the capital to risk-weighted assets ratio, is sitting at 30.96%. That's sky high.
Way above the regulatory minimum.
Massively above, almost double what most banks need. They're sitting on this huge pile of excess capital. So the provocative question is, how are they going to deploy that substantial capital efficiently? How do you maximize shareholder value with that much buffer while still funding the ambitious 14–15% credit growth they're targeting over the next 2 years?
Like a good problem to have, managing excess capital.
Definitely a high-quality problem for management. Something to watch. Okay, that's our deep dive for today. Thanks for joining us. We'll catch you next time.